Welcome to Proven and Probable. I'm your host, Maurice Jackson. Joining us for a conversation is Kevin Vecmains, the founder of VanAurum Financial Technologies. Mr. Vecmains, welcome to the show, sir.
Hello, Maurice. It's great to be here. Thanks a lot.
Glad to have you back on the program. In our last interview, we addressed the value proposition for the next capital vortex. Today, we will address central banks unwinding their balance sheets and the duplicitous effects that may occur and what actions you, the investor, may take to prepare yourself. But before we begin, Kevin, your company uses a unique skill set that I find intriguing, which is artificial intelligence for investing. For first-time listeners, please introduce us to VanAurum Financial Technologies.
So VanAurum is an intelligent lead generator for trading opportunities. That's probably the best way to summarize it. So we use machine learning techniques to detect anomalies and unusual market behavior, and then we report on it to members on a daily basis. So it tracks a global cross-section of sectors, ratios, and economic data points. And then when something occurs that has some kind of historical precedent for being either positive or negative for forward returns, VanAurum will report on it to members. So we think that by having an intelligent filter that's hand-picking market events to look at, it frees up our members' time to focus on things that they're actually really good at, like constructing trading strategies or doing analysis on their own particular issues. So if you use a charting service or you trade on technical analysis, VanAurum's definitely a must-have membership for you.
Kevin, your research has noted a mega trend occurring that is related to central banks unwinding their balance sheets. Beginning at the 10,000-foot level, can you share with us why central banks are unwinding their balance sheets and what this means for investors?
Well, we had, stepping back, starting in 2009, the Federal Reserve and most central banks globally eventually caught on to this as well. But they came out with an explicit program called quantitative easing to buy mortgage-backed securities and other debt-related securities from the balance sheets of different institutions, whether it was SMEs like Fannie Mae and Freddie Mac, or whether it was different financial institutions in the sector that were carrying this quote-unquote toxic debt on their balance sheets. But they grew their balance sheet from about $800 billion to almost $4.5 trillion. And they were maintaining it at that level for a while. And what it actually means when the central bank is maintaining the size of their balance sheet with these debt-related securities, what they're actually doing is that as securities mature on their balance sheet, they actively seek out other similar securities to buy to replace them so that they can keep the size of their balance sheet at a constant level. So the process of expanding the balance sheet, as well as maintaining it at a certain level, there was an implicit assumption in the market that the central bank was going to be there and be a significant source of demand for a lot of these securities. So that was the primary driver behind interest rates ultimately hitting rock bottom yields, most of them hitting 0%, in a lot of cases yielding negative levels. But it was the central bank was such a heavy influence on interest rates that in January of 2018, the yield on the S&P 500 was about 1.73%, and the yield on the 3-month treasuries, which is considered to be the United States' riskless asset, was higher than that. So you've got S&P equity yields, which is considered to be risky assets on somebody's balance sheet or within their portfolio. They're actually yielding less than the risk-free rate, which is a really amazing thing if you think about it, and obviously something that's really unsustainable. So going forward, the central bank has now communicated that they're going to shrink the size of their balance sheet. So in effect, what that's actually doing is it's taking a major source of demand out of this market for not only U.S. treasuries, but other mortgage-backed securities as well. And that's a simple supply and demand factor. And once that equalizes, we'll see it equalize eventually, but likely not until rates are much higher.
You know, I always find it disingenuous of the U.S. Treasury when they reference the rate of return that you'll receive on your notes is that you have the real interest rate and the nominal interest rate, and they only convey one of the two. Twofold question here for you, though. How will this impact currencies and capital markets?
Well, it's a great question. You know, as we've seen the Fed go through these hiking cycles in the past, typically any kind of economic turmoil led to a flight to safe haven assets like U.S. Treasuries. And of course, in order to buy U.S. Treasuries, if they're foreign buyers, it meant an uptick in demand on the U.S. dollar as well. But I guess the Federal Reserve they're in a bit of a tricky situation right now. And I think over time, more and more market participants are going to actually start picking up on this. But the level to which they've actually raised interest rates is not really that high, and within historical context. You know, there's an extended period of time that they were pinned along zero. They've been trying to raise the rates because I think they know deep down that the artificially suppressed interest rates were driving these yields, both on the S&P and in bonds, to disproportionate levels. So I think the next time around, if the market sees that the Federal Reserve is willing to reverse course, start printing money to buy up a lot of these assets, start down the path of balance sheet expansion again, in the face of a market that maybe reacts violently to what it is that they're trying to do, I think this time around it could be actually very negative on U.S. dollar and Western currencies. I think people are going to start to realize maybe how sustainable some of the debt trajectories actually are.
If currencies and equities will be negatively impacted, what is the prudent investment decision that one should make now?
Well, to me, in this situation, I like to look at, what were the major beneficiaries within the broad markets when the Federal Reserve decided to embark down this path of, explicit balance sheet expansion. And I guess the answer to that is bonds, equities, and to a large extent, real estate within major urban centers. So we've seen significant inflation in a lot of these markets. They were the major beneficiaries of what I call the risk premium compression that resulted from them artificially lowering interest rates. But we had strangely, everybody thought that commodities and other markets like that were going to go hyperbolic. But we actually didn't see that. And in my opinion, a lot of the reason why we didn't see that was because the market was front running all these explicit purchases from the central bank. Why wouldn't you, buy bonds if you knew that the Federal Reserve is going to be buying, $30-40 billion of them a month on an open-ended basis? So I think that drew a lot of capital away from, resource sector stocks, from commodities, any commodity really. And so I think this time around, when we see this whole process unwinding, to me, it only seems logical that the markets that were really beneficiaries of it might suffer, and the markets that really didn't benefit it are actually, I would argue, punished by some of these policies. I think you'll start to see a lot of those start to mean revert. So things like platinum, gold, resource sector stocks, energy stocks, which have been punished to a significant degree. Especially within the explorers and the producers, they've had some of the sharpest declines in record. So I think it all depends on how the market decides to react with the U.S. dollar whenever it is we get the next major trajectory change from the Federal Reserve. But my instincts right now, and all the data that I look at with VanAurum and our research suggests that the U.S. dollar will probably be negatively impacted the next time around.
So then the answer would be, if I'm correct here, is physical gold would be the first prudent investment decision?
Yeah, I definitely at this point, I always kind of advocate having some allocation to gold in your portfolio, especially right now, with the debt-based currencies in the West really starting to get balloon out of control. But, we're also... there's lots of fear in the market right now. We've experienced a significant correction in the S&P 500 and the broad equities. A lot of the valuation extremes that we saw leading up to this that was causing everybody to warn of bubbles. We've actually seen a fair amount of that bleed off, it's come back into nominal territories. I sent a message out to my members earlier this week saying that at this juncture, if the correction in the S&P 500 extends into bear market territory, closer to, being down 20%. At that point, going back to 1980, within our data that VanAurum analyzes, most of the precedents, if not all of them, are actually positive for 1-year returns going forward once the market has experienced a sell-off greater than 20%. So there could be drawdowns in the broad equity market from here. In September 2008, the market ultimately fell 40% before hitting its ultimate bottom. And then exactly 1 year later, from September 2008, the market was almost unchanged again. So, could the market accelerate to the downside again, and resume a bear market? It's likely. But at this point, I think prudent investors will start trying to anticipate some type of accumulation program for broad equities. But I do think that kind of the forgotten markets right now, like gold, which is carving out a multi-year base, platinum, which has been absolutely crushed recently, and silver are going to do extremely well in the environment that we're about to move into.
Regarding physical precious metals, would precious metal equities be the right place to be as well once someone has security positioned first in the physical metals?
Yeah, so I guess full disclosure, I have long positions in GDX and GDXJ. With VanAurum and in my research, I study sectors. There's lots of people that are really good at picking individual issues. But when we're working with our machine learning system, for reasons that maybe are beyond the subject of this interview, we try to stick with a sector. So I do have exposure to the gold mining equities through GDX and GDXJ. Now, absolutely, there's, depending on what the investors are looking for, royalty companies and the gold streaming companies really tend to do well during downside turmoil in gold and equity markets. Like we saw companies like Franco-Nevada, whose stock performed incredibly well during the gold bear market from 2011 to 2015. Where you really get your upside leverage in the gold mining and the resource space is when you're dealing with an issue whose cost of production is really close to the prevailing gold price. Because that, what happens there is you get profit leverage. So if you have a gold mining company that's selling gold for $1,200 an ounce, and say their all-in cost to produce that ounce of gold are $11.99, so they're making $1 of profit. If the price of gold increases by $1, then the earnings for that particular company increase by 100%. So you go from $1 to $2, you double your earnings. And so that's what we mean by profit leverage. You start to see a lot of the high-cost companies really start to accelerate when you see gold moving into a particularly strong bull market. I think what's happening right now is you're seeing a lot of the accumulation and a lot of the higher quality issues, and they've been doing well for quite some time. But the sectors like GDX and GDXJ, I think, have been languishing, partly because they're full of lots of producers that a lot of them haven't been doing particularly well in this environment. But I think that will change if gold can stage a major breakout. I think you'll see a bid under pretty much any company that's producing gold if it can stage a breakout and sustain it above $1,400 US.
Switching gears, Mr. Vecmains, what is the next unanswered question that VanAurum Technologies is researching, and when do you believe we will have an answer?
Well, right now, to me, the elephant in the room is with what's going on with interest rates and how the market is fully going to react to the Federal Reserve removing itself as a major demand source in the debt markets. So it seems to me like there's a little bit of disbelief. You're starting to see 2-year Treasury yields, which is a fairly close proxy for interest rate hike expectations. You've seen a lot of those rates come down recently. Some of that might have been because the yields were overbought, and the bonds were due for a rally. But to me, it really is the biggest question, because the Federal Reserve was such a huge component of this equity rally that we had from 2009 until now. I think whatever their action is going to be a major component of how the market plays out going forward. You can see the market kind of starting to begin to call their bluff. But what I'm really interested in finding out is what the Federal Reserve actually intends to do. If the market truly starts to react violently to their rate hike cycle, are they going to end it? And are they going to start to ease again, meaning increasing the size of their balance sheet? Or are they going to start cutting rates? I think if they start cutting rates, having only reached the levels that they're at, I think that it's going to be a really, really scary warning sign to market participants everywhere that the U.S. economy just can't handle higher rates and has become almost addicted to the Federal Reserve accommodation. And I think at that point, how the market reacts to that is going to be the primary determinant of which people are going to make a lot of money and which people are going to lose a lot of money. Yeah. And I think we'll have the answer to that probably by the summertime.
Truly interesting times and unprecedented times, and I'm tickled to death to be here just to watch it and actually participate. Sir, last question. What did I forget to ask?
I think we covered a lot, Maurice, but if you're okay with it, I'd like to discuss a little bit about VanAurum's AI curated newsletter that we put out daily. So I touched briefly on the service when we first started the interview. But the core of our research service that we offer right now is our daily AI curated report. It's really a publishing process that we've designed, which kind of merges the things that machine learning algorithms and machine learning systems are really good at with the things that people are really good at. So I'm a big believer fundamentally, and my readers know this, of kind of the convergence of machine learning based systems and human based systems. I think both types of, both people and machines are really good at particular things. And what I try to do at VanAurum is to create workflows that combine the best of those worlds. So what our AI curated report does is every day VanAurum is analyzing this global cross-section of assets, whether it's Chinese stocks, Israeli stocks, resource sector stocks, yield curves, economic data points. And what it does is it figures out when something is behaving unusual in the market. It performs some hypothesis testing on it to see if there's any historical precedent for meaningful positive or negative returns. And then it presents that in a report to our members. And that's kind of the launch point for analysis that we do. So we're getting this pipeline of trading and investment suggestions coming from VanAurum daily, which are really high quality. Our members love it. The feedback I get from the members is that it's exposing them to things and markets that they wouldn't have thought to look at before, which is really what it's all about.
And sir, for someone that wants to get more information about VanAurum Financial Technologies report, please share the contact details with us.
Sure, yeah. Readers and listeners can visit vanaurum.ai. That's VANAURUM.ai. And we have a public version of the report, which is delayed a certain number of days to kind of keep our best information fresh for our members. But if they're interested in how that report works, there's a link on our homepage to their public report. And they can also take a look at some of the other services that we offer as well.
And we would like to take this opportunity to remind our listeners, if you're interested in buying or selling physical precious metals, please call us at 855-505-1900. That number again is 855-505-1900. Or visit our website, ProvenandProbable.com, where we interview the most respected names in the natural resource space. You may reach us at contact@ProvenandProbable.com. Kevin Vecmains of VanAurum Financial Technologies. Thank you for joining us today on Proven and Probable.
Thank you for joining us today on Proven and Probable. Remember to like and subscribe for more conversations with the most respected names in the natural resource space. Check out our website at www.provenandprobable.com. The information presented on Proven and Probable is provided for educational and informational purposes only, without any express or implied warranty of any kind, including warranties of accuracy, completeness, or fitness for any particular purpose. The information is not intended to be and does not constitute financial, investment, or trading advice or any other advice. You should not make any financial, investment, or trading decision based on any of the information presented without first undertaking independent due diligence and consultation with a professional broker or competent financial advisor.